guys. Welcome to the podcast. Thank you for joining me. Appreciate it. Doing this podcast a little bit early. Have some meetings later on, but I wanted to get this out to you. So the markets are still open for another couple of hours, but really the big news on the day is Apple, and I'm going to have a lot more about Apple on this week's radio program. If you want to tune into that, 7 a.m. on Saturday. It's streamed and on klup.com, or you can listen to the archive after the fact. And most of you are probably getting this via the alerts, and so you'll be getting an alert once the show comes out. But I'm going to get into a lot of details about Apple, really more about the fundamental side of Apple and what kind of stock it is and who owns it now versus maybe a year ago, and as opposed to just the technicals. But we'll get into the technicals here in just a minute. Well, the Dow Jones, you can see here, I mean, as of right now, the Dow's down about 12 points, and who knows how it'll close, but certainly not the oomph that a lot of people thought after a lot of earnings came in last night, and it seemed like it would push it up, and it certainly helped tech at the beginning of the day. But if you look at the Dow here, the main thing you have to determine is where are your entry points? Where's your low-risk entry points? Are your low-risk entry points here at this quadruple top now, or are they when it sells off a bit? And obviously it's when it sells off a bit. So if you're trading or you're looking to put more cash to work in certain areas and it's a position that's more tied to the market, in other words, it moves like the market on a day-to-day basis, then what you need to do is wait till you get to the other end of the spectrum. So either, this thing comes back down, maybe it comes here, maybe it comes here, but you're getting it at a cheaper price, or at the very least, you wait for it to break out and get firmly above that and make new highs. And preferably, maybe it comes down and tests that old support, and then it goes off to the races. But certainly it makes it difficult to buy it in this little spot here because, again, we've got a pattern here where this has been the ceiling. This has been the spot where it has trouble. And we had kind of a fake out earlier where it went up kind of new highs, and then back in late March, early April, and then we had that sell-off. But since, really, if we flip over to the NASDAQ, we had that big reversal day. Remember that? That was on April 15th. It was tax day. And we had the big reversal. I think Janet Yellen had spoke, and it turned things around. The NASDAQ bounced right off of its 200-day moving average, which is this red line, and then off to the races. But if we kind of look at it here and zoom in, you can see that we're still making lower highs. So in order for this trend to be reversed, we have to go up above here to break this down. Otherwise, what's going to happen is we're coming up here and we're just going to continue to fail. And maybe it bounces again and then eventually breaks. But the point is right now, again, the low-risk entry time was after the market had sold off, not after it's bounced. But now we're kind of close to the ceiling once again, pushing to the 100-day moving average, the 50-day starting to roll over. So it's not all clear. Now, in the last few days, we have seen some of the internals improve a bit. The thing that's got everybody concerned is this picture. And if you look at the volume here, you see what's happening. So as the market's recovered, the volume continues to be anemic, shall we say, and not going anywhere. But if we get back to the S&P, just with the volume aside, it's the same kind of picture, I think, overall as the Dow Jones. We're up here kind of trying to get through these old highs. And after a pretty good run here, and probably we've had 7 out of 8 days have been up, threatening to roll over once again. So let's watch it here, see if it takes a break and then pushes on through to the upside, or are we, again, setting ourselves up for lower prices and maybe it goes down lower this time? I don't know. I wish I had the answer for you. So the way I'm playing it right now is a couple of ways. Number one, I'm not getting too bearish, so I don't have tons of cash. I took some profits in the last few weeks on some things, got stopped out of a few things for losses, but built up a little bit of cash. But I am adjusting in some other areas. So there are still things to do with your capital. It just may not be the overall stock market. So you need to see how correlated your positions are on a day-to-day basis. The other thing, as we always stress, is look for income, right? Look for some things that have nothing to do with the stock market and you're just getting paid. And then stay in the strong areas. One of the stocks that we own in our aggressive portfolio, full disclosure, is Devon Energy. And this thing has been a beast and is going vertical. So now, what are we looking to do? We're not looking to buy it, right? We're looking to, and buy more of it. We're looking to actually take profits at some level. So that's what we spend our time doing, is looking at this saying, when would we want to sell this? And you have to go back, if you kind of look at the weekly picture here, you can see you have to go back. The old high was 76.50, so it could threaten that. It could threaten that easily. So those are the things that we're watching. But again, we're looking to sell that at some point, and we don't want to do it too early. But the point is that this is not the time to be buying it. The time to be buying it was when it wasn't doing anything and nobody liked it. So there's stocks like that. Also, if you take a look at the biotechnology, this is something that's been in the news over the last several weeks. And of course, we have all this volume here that is picked up quite a bit. You can see the big spike in volume over the last few weeks. But again, just like the NASDAQ, it had a bounce. It was due for a bounce. But is the bounce going to, go straight up, or is it going to come up here and fail at the 100-day moving average and make lower highs and lower lows and continue that? Because this is really the trend that it's in right now. And until it breaks that, you have to think that this is the time, if you bought it down here in the panic, this is the time you may want to take some profits. So again, we're talking about trading here. We're not talking about investment. If you're talking about investment, this is starting to look a lot like a bubble and has been. And the reason why is, if you notice, there's a lot of companies starting to buy each other. And that's exactly what happened during the dot-com era, wasn't it? They used their expensive stock to go acquire another expensive stock, and they both get hurt. And so really, if these technology or biotechnology companies are smart, they go and use their inflated stock price to go purchase real assets, real estate, companies with real profits, things like that, not go buy another biotech company that's betting on one drug. So watch that, but not real impressive what's happened with biotech, just a mediocre bounce. But this is the old intraday low, so it has to hold there. So if it comes back down and bounces off there, maybe it's setting itself up for, the worst is behind it. If we move on to volatility, this is the volatility index, and you see the big spikes, and those are the low risk times to buy. Well, we're on the lower end here. So again, it's not to say you necessarily need to sell, but the easy entry point is when we get the spike up here. And we got a little bit of a spike, didn't we? And that wasn't a bad entry point, but the easy ones are when it comes up much higher up here, and we haven't had that. We're on the lower end right now. Volatility is up a little bit today, but nothing major. Now, kind of the story of the day has been, and by the way, let's take a quick look at gold before I get to Apple. So here's gold, and you can see a lot of people were worried about this 100-day moving average. It's already below the 200-day, but this is kind of a key support because you had this move up. It kind of gave half of those gains back. The gains were earlier in the year, bounced around here, and if it can hold this, and it had a reversal today, if it can hold this general area, gold is hated right now. I mean, nobody likes it, but if it can kind of hold this general area right here, then it has a good chance of moving back up to these old highs. So watch gold. I do own it. Don't have a bunch of it, but I do have it. And lastly, here's Apple. This is the stock of the day, up 8% as I speak, about $42 a share. They did a 7-for-1 reverse, I was going to say reverse split. That would have put it like at $3,500 a share. Not good. But they did a 7-for-1 split. They increased their stock buyback program from $60 billion to $90 billion. They also increased their dividend by 8%. Earnings were better. And there is some deterioration in some of the parts of the business. But again, I'm going to save a lot of that talk because I'm going to spend a good segment on it on the radio show this weekend, so make sure you tune in for that. But as far as the stock's concerned, technically, that's all we're talking about here, it kind of did what it was supposed to do, right? We had the big drop, and this is a daily picture. We had the big drop from 2012 all the way to mid-13, went down about 45, let's call it 50%, got cut in half, had a double bottom here, kind of a classic double bottom, bounced real hard. That wasn't the time to buy. It was on this dip, and I think that's kind of where gold is right now, as a matter of fact. You put the picture on top, gold did that double bottom, bounced, and now it's down here. So gold may have, again, a little more upside, and it's kind of a contrarian opinion, but we'll see. But Apple, these moving averages all turned up, and crossed above the 20 and the 50 and the 100, all crossed above the 200, and everything's heading in the right direction. And then it made this new high, and then it kind of just moved sideways. And all we're doing is getting back to that old high today. So technically, if you're looking at this, I don't expect it to race away from you here, but it is a stock that people have to own. And I don't mean you, I just mean institutional money has to own that. So I can see Apple, again, working its way higher over the next few months. But I don't think there's a huge rush to go in there and buy Apple. I think it could consolidate some of these gains further, and because this was a big run. I mean, look, from the low to the high, that was a 45% move. and now it's kind of just moving sideways. So let it congest a little bit, but you do have better earnings now and some better metrics to, justify the price. So again, cheap stock, PE's 13, the yield's over almost 2.5, but we'll get into the fundamental side of it and really how people should own it and why they should own it on this week's show. So make sure you tune in for that. All right, that's going to wrap it up today. Thanks for joining me. Appreciate it. Don't forget to go check out the new website, eggerscapital.com. Take care, everybody.